Hello, everyone. Welcome to Momentum Lab. In this episode, I'd like to introduce you all to Vishranth Suresh. Vishranth Suresh runs AssetPlus. As you are aware, AssetPlus is a leading mutual fund distributionship platform in India. And Vishranth has been a pioneer in this, molding the AssetPlus into a tech-led platform, boasting more than 12,000 MFDs and close to 1 lakh individual customers, managing an overall assets under management at 4,500 crore. Asset Plus is a recent startup and has seen tremendous scale. Vishranth himself is from IIT Madras, an MTech and BTech graduate in mechanical engineering. Vishranth, glad to have you on our podcast and would love to know more about your journey at Asset Plus and your personal educational background. If you can shed some light, that would be really great.
Okay, sure. So firstly, thanks for having me on this conversation, Shekhar. So, and yeah, thank you for the introduction as well. As you said, the last 3-4 years is where we've been able to really scale as an organization. But I think yeah, prior to that, happy to chat about like what brought us here, because I do think we've had a pretty interesting journey, right? It's technically not what an core engineer from IIT Madras will expect to build, but I think circumstances have brought us here. So yeah, I'll talk a little bit about that. So firstly, like you and like possibly like many of the audience we currently have, I was also hooked into the equity markets at a from a very young age, right? So by the time I graduated from IIT, this was 2015. I'd already been spending a year and a half, spending a lot of time to research about mutual funds and stocks while in college itself. And I'll also have to accept that I am a mechanical engineering, as you mentioned, by a major, but not something that I personally found extremely interesting. So, and you do get a lot of time towards the end of your college years, especially the fourth and fifth year to take up projects on your own. And since I was not too keen on pursuing mech as a full-time career opportunity, I was looking more at what else can I do, and somehow I landed up in equity market. So it was very fascinating, especially for someone who used to like mathematics a lot, right? All I initially understood was people invest money and somehow they magically get profits, right? Who is doing that? Where is extra money coming from? What is really happening? So many stocks every day, their prices change. So many mutual funds. It's like a very magical, fascinating world for me back then. So for me, it was a very magical, fascinating world, right? Because we make investments, we are investing in stocks, but somehow profits are coming. Where is it coming? Who is generating the profits? All of these was very, surprising for me to learn. So, and having spent so much time prior to graduation, also extended this to take a very unconventional bet to say that, you know what, there are so many things in the financial world, and there are so many people who require help on understanding all of this, because not everyone might have the time and be able to put in the effort to understand more about investments, take good investment decisions, select products, and so on. I saw a big gap there. So decided to take up the journey of becoming a financial advisor myself. So that's how Asset Plus was started. And then 2016, also fortunately roped in my co-founder Avnish, because we felt there was a large problem in the financial advisor industry then, that everything was paperwork oriented. Right now things are much better, but in 2016 you could not start an investment without couriering documents to maybe Mumbai, or waiting for like 10-15 days. It was a very a poor experience, which deterred a lot of youngsters to start investing. So the idea was to be able to give good financial advice, but also make the entire transaction process as seamless as possible, so that financial advice plus tech are the two value propositions that we can offer. So started off with that, and did that for 3-4 years, gained a fairly good client base, and eventually the platform that we had developed itself had become super robust, right? And we noticed that many individual financial advisors who existed, right, themselves wanted to also use a similar platform to grow their business and to give better recommendations to the customers, to be able to handle the customers at scale better, to grow their business digitally and so on. So we saw that why just use this platform for ourselves when we can also offer the same platform to other advisors. So that was a small pivot we did. At that point, it was small. Now I think that's developed into a fairly quite sizable business for us. So as we stand today, we are nearing about 4,500 crores of investments in mutual funds managed on the platform, by about 12 to 13,000. Back then, they were called IFAs, Independent Financial Advisor. Now they are called as MFD, Mutual Fund Distributor, but it's all one and the same, just that the parlance changes. So, and my belief from the time I've graduated itself has been that money has way too much of an emotional component, right? Especially in a country like India. And not it's very important for this and the future generations to spend a lot more time and energy to manage their finance to be able to achieve goals. But not everyone will have the time or the expertise to be able to do. So I strongly felt that for a large part of the population in India, having a very trusted, credible financial advisor who can be a good personal financial coach, who can be a good, a good person to select right products for you, who can manage your portfolios, who can give you regular updates about the market. One such confident person on whom you can trust, place your trust, will take care of all of your financial problems. So I was among the few proponents 7, 8 years back where I felt DIY is not meant for everyone. In fact, a large number of people will have to work with a human financial advisor only. And as long as the advisor is very competent, is transparent about fees, and the fees have also come down drastically over the last 6, 7 years, that is probably the best way to go. And investors are maybe better off spending their time and energy in growing their skill sets and earning more rather than figuring out and spending more time in figuring looking at how to save more money, right? To where to invest their money. That's a job that an expert, credible expert can handle. That has been my view, and I think that's what has brought Asset Plus to where we are today.
I completely echo your points, Vishrant. Even though we have been a platform to promote DIY investing and teach certain aspects of quant investing, but when the push comes to shove, when the markets are turbulent and volatile, many of them actually are reclusive, and then they go back to their safe comfort zone, and they actually look or find solace in someone who can give a credible advice. And then when the markets are bad, then people realize the need for a good advisor. And definitely the lines are blurring between the expense ratios between the direct and regular funds. And I think that's where the MFDs can add more value, especially in the turbulent times. And also in terms of the cost differential, it actually doesn't matter much in the larger scheme of things if you are looking at a longer horizon of 5 to 7 years. Great. And I'll do a separate
Correct,
video.
Shekhar. I think there are a couple of points that I think a few points just to share my take on what you mentioned. It is in fact very important for investors to know, right? So there are two aspects to this. One is in terms of competency, and second is in terms of transparency, right? These are two things that are paramount for any financial advisor to be able to have a successful career and contribute to the customers and to add value to the customers. So number one, Shekhar, is see, when I started as an advisor myself, mutual funds were very nascent, right? It was hardly a household name back then. There was a time when advisors used to get paid 1.5–2% as fees, right? In fact, in multiple developed nations, still today they get paid that much. But this is one area where we have to appreciate what SEBI has done, because as mutual funds became more and more popular, the volumes have started shooting up. The fees that is being paid has also tapered down, right? Say today, if you look at it, a typical good advisor who's successful can earn about 0.5%, right? And based on the competency of the advisor, right, in terms of selecting the products, in terms of right rebalancing, in terms of being a good coach, 0.5% of a fees is actually something that most of the advisors can easily deliver much more value than that, right? So on Asset Plus, we have seen the top advisors who handle maybe 100 crores, maybe who handle 80 crores, 200 crores, typically add at least 2 to 2.5% in value to the end customers in multiple different ways, for which the fees could be anywhere between 0.5 or in some cases 0.7, 0.8%, right? So I think now it is a very fair play. And although a lot of unfortunate or maybe like a little bit unnecessary a negative connotation has been created, but that is where customers will have to choose advisors with competency. Like say, there are advisors who are really customer centric, knowledgeable, quite like yourself, who can play a very strong role. But unfortunately, like every industry has its own set of bad apples, right? Financial advisors also, there are some corporates, there are some banking institutions where the way they recommend investments might not be in the best capacity of what is good for the customer. So I think customers will have to be smart enough to choose. But I think these days it's become very clear that MFD as a profession is a way to go.
Absolutely. Yeah. So since we have our bias towards factors and passive investing, I'd be keen to know from your vantage point, Vishwan, two things. One, can you tell us the difference in terms of the expense ratios for a regular and an active, for a regular and a direct passive funds, or something like momentum fund or Nifty 50 index fund? The difference between regular and direct. That is question one. The question two is, at your organization level, how many, what percentage of the customers are choosing factors or passives in their portfolio? Just maybe a percentage would be a very helpful number.
Okay, sure, Shekhar. So, firstly, when it comes to expense ratios, right? Say, largely what causes a change in the expense ratio is it is essentially fees that is being paid to the asset management company, right? So, what are the costs incurred by the asset management company is what is going to influence the expense ratio as well. So, very simply put, if you look at factor investing as a set of funds and compare it to actively managed funds, right? The biggest advantage is most of the factor funds do not require an active management, right? The human bias is completely removed because it's all quantified and it's a rule driven rather than a fund manager driven kind of an investment philosophy. So by nature, what will happen is active funds will continue to have a bit of a additional expense ratio than factor funds, and specifically within regular and direct or factor funds, usually the difference between them for factor and passives is not more than 0.3 to 0.5%. That is a maximum difference. But there are cases where the difference can be for up to 1.25%, but these are mostly to do with thematic funds. These are mostly to do with sector funds or very strong active funds where the work by the AMC as well as the advisor or the distributor is quite high in terms of being able to identify when are these funds to be recommended, right? Say today, if you look at it, maybe take a ABC sector fund, right? What is that particular sector's valuation? What does the outlook look like? Is it a good time to give an entry call? Is it good time to give an exit call? There's a lot more work that the MFD will have to do in being able to identify and provide these as recommendations. And so adequate compensation comes along with it, which could be 0.75 or 1%. But factor and passives, typically the difference in regular and direct is not more than 0.2 to 0.5%. That's the 90% of that fall in this range. That's number one. Number two, in terms of what we have seen as a trend is factor and passive is definitely increasing. And what people are doing is people are now open to start experimenting with a certain percentage of their portfolios being allocated to either passive or to factor based investing. But overall in India, factor is very, very nascent. Like, in fact, I would take a step back and say in India, mutual funds itself are very nascent, right? Not even 4.5% of the population is investing. So we have a super long way to go. And within this 4.5% of investing population, factor investing is a much smaller percentage. So there's huge room to grow. It's both in India, and we see a similar trend on AssetPlus. It has ideally not picked up to where it has in developed nations. That's where we are.
Makes sense. I think that's pretty interesting. If it is only 0.3%, which is the difference between a regular and a direct fund, actually it is not much to say. And if I may know, since you've said the number that only 4% of Indians have opened a mutual fund, I'm curious to know the remaining 96%. Are they in the tier one, tier two cities, or are they in the tier three cities? Do they bring this similar kind of AUM? If at least, if out of the 96%, let's say only 10% are on board yet, would the growth come in terms of the growth be the same in terms of the AUM, or it is only the folios getting opened up? Curious to know about that, Vishranth.
Okay, sure, Shekhar. So, in terms of this, right, say the opportunities available for growth. What is now happening is, fortunately, mutual funds is slowly becoming a household name, right? The mutual fund Sahi campaign has helped. A lot of regional campaigns have also helped. AMCs, advisors, distributors, everyone is playing a good role in increasing the penetration levels. But what tends to happen is people, as humans, tend to look for an excitement factor, especially when it comes to their investment, right? And whether we like it or not, the truth is mutual funds are super stable for long-term investors, right? But there is no excitement factor. In fact, there should not be an excitement factor when you're investing for long term, but that is what human nature wants, right? So something maybe like similar to fantasy gaming, maybe something similar to trading in futures and options, something in maybe currency or forex trading. The risk involved is much higher, but the potential returns that it can offer unfortunately ends up tempting a large part of the population much more, right? So a good product as mutual funds which can give you predictable returns over the long term has not caught up to the extent that many of the other products that I've mentioned have caught up. So what I believe investors should look at is, number one, everyone has financial goals that they will have to meet. Inflation hurts everyone has families, who depend on them, kids education, early retirement, so many personal goals that they will have to save for. It is important to ensure that the core part of their overall financial portfolio is in stable instruments, and their mutual funds play a very strong role, right? Once you know that a large part of your core portfolio is stable and you're on the way to achieve your financial goals, it is perfectly okay for you to maybe allocate 5% of your portfolio, 10% of your portfolio to trading, or maybe a larger percentage to equity, or maybe to even crypto. So I do not believe that you should not do anything else at all apart from mutual funds. I strongly believe a good part of your portfolio should be in mutual funds, and everything else, maybe the last 10% or last 15%, it's okay for you to experiment, just, but do not experiment with your entire portfolio, is what my advice would be. And this is also picking up, penetration levels are increasing. So right now the mutual fund is about a 65 to 70 lakh crore industry, right? But compared to bank deposits, it's not even half. Right, still most of the money goes to bank deposits, especially in tier 2 and lesser areas. So the expectation is that industry can easily grow 3x to 5x in the by end of this decade itself. So huge amount of opportunities are there. But I think the more awareness that's created, the more work that advisors do, AMCs do, and the regulators do, all of this will contribute towards stronger increase in the mutual fund penetration.
Well, massive. I think the 3x, 4x growth, it looks impressive. The exciting times ahead in India. Now, specifically, let's say if we were to focus on a couple of factors, uh, are there any specific factors do you think an investor can have in their core portfolio to ride across different market cycles?
Okay, so in terms of factor investing, Shekhar, so all these again are my view personally, right? Say what I have seen is a lot really depends on the investor's risk profile and how these are personalized, right? Say for example, if you take momentum as a factor, right? Say in a raging bull market, momentum-based investing will really generate strong returns, but the moment the tide turns, the risk involved is also very high, right? But if you, for example, look at something like a low volatility this factors, then these are actually pretty good for people who are expecting a bit more stability, but are not too focused on the return aspect, who are more looking at the risk management part of their portfolios. They can consider something like a low volatility. So there are so many factors, and each of them have their pros and cons. What usually might work is, rather than looking at particular having one or two specific factors which can have very prolonged period of underperformance based on markets, a better approach will be to consider a multi-factor approach where, say, you have 100 rupees to invest that you have dedicated for factor funds, right? It is okay for you to maybe have 25% to, say, momentum, 25% to maybe value, 25% to quality, and remaining 25% you can shuffle around and take tactical bets. So again, a core and a satellite sort of an approach within factor investing, it's what will work. So the core part of your factor portfolio ideally should be in multi-factor, so that you're not too influenced by what's happening in the markets, and also not taking unnecessary prolonged underperformance risks as well. But within factor, you should have a satellite which portfolio, which is what you will contribute to taking tactical allocations based on the market conditions that either you can decide or your advisor can provide. So that is what I broadly feel is a good strategy to have.
Wonderfully. I think it definitely makes sense because while we do a lot of videos on multi-factors, and I think these multi-factor approaches have shown to exhibit resilience across market cycles and have a better risk-adjusted returns than the other pure factors. Interesting. Thanks a lot, Vishant. And there's one last question that I would like to ask and wrap it up. And if, let's say, if one were to, or a retail investor were to start to invest on AssetPlus, how should they go about?
Okay, sure. So I think I could maybe take a step back and make it a little bit more broad. What I feel is a process that retail investors can really choose, for their investment. So step number one is, I see investing as some form of a race, right? Not a short-term race, but more of a marathon. So number one, any form of an investing should ideally start with an end goal in mind, right? It is akin to saying that I would like to start a marathon, but I don't know when I'm going to stop, right? So that should not be the case at all. Once the financial goals are clear, and even if you might not have a goal, it's always okay to have a milestone, right? Because everyone has some common goals. Emergency fund is a goal for everyone. Early retirement or maybe retirement is a goal for everyone, and many of them will have kids education, kids marriage, maybe a purchase of a house. So many different goals are there. So the first step is to be able to evaluate, either by yourself or in consultation with your advisor or distributor, what are your goals, number one. Now that these are set, second piece, which is actually quite important and I feel is missing in India a lot, is the risk profile, right? What tends to happen is investors can become very biased based on recent market performance. If 6 months back I asked all the investors, are you an aggressive investor? 95% would say yes, right? But today, if I ask the same question after the kind of drawdowns that have happened, all the investors who said aggressive, 90% of them have suddenly become conservative investors, right? So
That's true.
this is actually the major challenge that can have a strong impact in your portfolio, because you will end up markets keep changing, right? And you will end up taking a lot of quick decisions that will have transaction costs, and you will keep underperforming for a long period of time. So being able to evaluate a risk profile which not only considers how comfortable are you with the risk, but also considers your financial goals, right? Long-term goals can have a better risk profile. Short-term goals, even though if it might be even 2 years or 2.5 years, it is better to not take equity risk at all. So that financial goals and second step, risk profile will be the most important factor. Once these are done, you might have SAPs, you might have lump sum investment. That depends on investor to investor. Once you have allocated the investments for particular goals, it is perfectly also okay to have some additional experimental money with you, with which you choose to maybe invest in stocks. You could invest in, like maybe crypto. You can even trade. All of that is okay, but as long as you keep it as a small portion of your portfolio and not your entire portfolio, right? Because if in case something happens, no one is going to come and help an investor who has lost the money, right? You are going to be accountable for your own money. So once you have constructed a very strong stable foundation by planning your goals, planning your risk profile, and starting in your investment with mutual funds, the final 10-15%, it's up to you to play. And even within mutual funds, I do take the approach that there is no right answer about active is best or passive is best, or like maybe factor is best, or within factor which is best. It is usually a well diversified approach that has good risk adjusted returns for the long term, right? So there are segments of the markets at some points where any active fund manager finds it quite difficult to beat the index, right? So there you need to be able to identify, or your MFD needs to be able to tell you it is better to just do passive, right? Why incur any cost? But there are segments all the time where you can find out that maybe a sector investing will generate significant alpha, right? Say, for example, in the last 6 months, you will notice that a couple of sector funds have not even fallen by 5 to 7%, whereas the broad indices are 15 to 20%, right? So these sector bets are something that you could take, but these likely will have to be in active funds, right? And factor investing, again, there are multi factors, there are particular factors. So it needs to be a mix of all this. If you are a very if you're starting out small, maybe it's a 5,000 SAP or a 10,000 SAP, you need not have to complicate all this. Maybe a simple factor fund, maybe a simple flexi cap fund that is able to beat the benchmark regularly is more than sufficient for your long-term goals. But as your portfolio becomes larger, maybe you have eventually a 5 lakh or a 10 lakh portfolio, it needs to become more and more diverse, right? Because there's a very common saying that I really like. So as your portfolio grows in size, return of capital is more important than return on capital, which
Right.
means that when your portfolio has become maybe 2 times of your annual income or 5 times of your annual income, it is okay for the portfolio to maybe deliver 12% or 10%, as long as it's not falling from 50 lakhs to 30 lakhs, right? So your risk profile has to taper down as your portfolio grows over a period of time. So you should be able to plan that, or your advisor should be able to plan that as well. So with all of these in place and a structured process, and more importantly, not getting once you have planned all of this, not getting too bogged down by short-term volatility and reading too much of news in the media and wanting to take action, will probably result in the best results for an investor's portfolio. And I also strongly believe in one of the other sayings in stock market, that investing and creating wealth is like watching paint dry, right? That is it's fortunately or unfortunately, patience and long-term investing focus is what works for 90% of the investors. So do not get distracted by get rich quick sort of schemes. And that's something I see in the recent trends you need to be particularly careful about. So
Thanks.
these are my directions, and some of the guidance points I can share with the audience.
Thanks a lot, Vishranth, for sharing those with nuggets of wisdom. Just to summarize, there are three main points that Vishranth had highlighted. One, know your goals, know your risk profile, and construct a portfolio which has a core and a satellite. A core can have a flexi cap, it can have multi-factor or maybe passive index, and the satellite can be a bit experimental or aggressive based on your own preferences. And the lines between the direct and regular are blurring. There is a merit in active as well as factor as well as passive. There's no one size fits all. It depends on the situation and also the current state of market that you're in. You can always find pockets of alpha, irrespective whether it is in factor, passive, or sectoral thematic bets. These are the main summary points. Thanks a lot, Vishrant, for your time. Really appreciate. And I'll do a separate video on doing a deep dive into the AssetPlus platform and be showcasing the different features that you just talked about to our viewers.
All right. Thanks, Shekhar. Again, thanks for having me here, and hope the Hope you as well as the audience find the information useful. Yeah, happy to share more information as required. Thanks, Shekhar.
Thank you. Have a nice day.